Andrzej, we've hit the start of summer. So what is the probability in your eyes that the U.S. enters a recession sometime later this year?
Hello, Greg. Always a pleasure to speak to you. We think that is a real possibility, but not our base case scenario. So far, the US consumer has shown itself to be very resilient. And yes, there are lots of fears to do with trade wars, to do with clarity over the business cycle, strength of the labor market. But we do think that US has a good shot at avoiding a full-blown recession.
Well, at least according to treasuries, buyers have been a little bit skittish, if you will, because we've seen the 10-year hanging around 4.5% and the 30-year hanging around about 5%. So what does that tell you?
Well, it tells us that investors demand more compensation to buy long-duration treasuries. They are worried about the level of deficit in the US. We're running close to 7% deficit level, and that, in the mind of many investors, is too high. So with record treasury issuance ahead, it should not come as a surprise that investors are demanding more compensation, especially for longer duration treasuries.
So do you see those so-called bond vigilantes coming back to the market? And if they do, what are they going to do?
Well, the way we would describe it is we do not expect an earthquake. So we do believe that treasuries will have a key position in investors' portfolios globally. However, as issuance is very heavy, as those deficit fears percolate, you could see tremors. You could see specific auctions that will be weaker than others, raising those concerns. So we don't think it's the end of the story for treasuries, but people need to be prepared for some volatility.
So if we see a tremor like we did recently with a 20-year bond auction, what should investors do? Should they buy the tremor or sell the tremor?
So far, buying the dip has been a really good strategy in markets over the recent years. But this time around, because the level of deficit is so elevated, we find much more comfort in shorter duration treasuries. So for investors who are worried about growth, we would point them towards two-year treasuries as a safe place to store capital, whereas for longer duration treasuries, we would tend to avoid them and focus on curve steepening trades where you are underweight 30-year duration, but focus on being long short end of the curve.
So for financial advisors who are allocating to the fixed income markets, how should they break it down in terms of treasuries, munis, high yields, corporates? What are your thoughts across the spectrum, across the plane of fixed income assets?
Well, if you think about it this way, we're in a higher for longer environment. That could well happen with Fed unable to cut rates a lot. So in that environment, you want to have carry, you want to have income from your fixed income investments. So with that in mind, we like areas like leverage loans, where you get pretty high levels of income. We like short duration treasuries, where you are more protected from volatility in the rest of the treasury market. And we also like credit. Less so in the higher quality segments of the high yield market, where there's very little value left in our opinion, but particularly in investment grade and in the middle of the high yield range, single B rated securities, there's still value left on the table there.
And then finally, what about international stocks and bonds? Because that's the other thing we've learned so far this year, is that investors kind of like investing abroad.
That's for sure. And with some of the markets, like for example in Europe, you have more clarity over the path of interest rates than is the case in the US. So on a currency hedged basis, some of those offshore investments could look attractive. Having said that, 95% of investments for US investors goes into US opportunities. And that's where we think you will see the broadest pool of demand going forward.
All right, well, thanks for coming in and talking about it.
Always a pleasure to see you.